Good morning, and thank you for joining our webinar today. Brian and I are here to really help increase understanding on the whys and best practices on managing your cost of goods, or depending on how you call it, cost of sales. With the restaurant margins being so small right now, every penny counts, and your cost of goods take up a significant amount of your overall expense. So it's really vital that this is being managed properly. So we hope that the information we review today with you will assist you in understanding the importance of this area and how it can negatively impact your profitability and cash flow if not being handled accurately and consistently. We're going to try and complete this webinar in about 35 minutes today, given some extra time at the end for any Q&A that you might have. So just so you can plan how long this is going to take. My name is Sydney Lynn. I am joined today by Brian McKay. Brian and I are both client advisors at RSI. So if you are interested in learning more information about our services, feel free to reach out to us at any time. So let's actually get started today. So we're going to be touching on a few items. First and foremost, what are cost of goods and how are they calculated? We want to help you understand why counting inventory really does matter. We're going to discuss some common misconceptions and myths around factors that are affecting your cost of goods. We're also going to review best practices to ensure cost of goods accuracy, as well as for managing, controlling, and waste. And finally, why vendor relations and purchasing programs can assist your overall costs. But before we get started today, I think we should start with our first poll question. So Brian, what's our first question today?
Yeah, let's get into it. And we like doing these poll questions throughout our webinars. It's a great way for everyone attending to participate. We'll ask the question, we'll share the results, and then we'll talk about those results. So there'll be a couple of those throughout the presentation today. In addition, before I pull the poll question up, I want to point out that there's a Q&A section that some of you have already started using, so thank you for that. But we'd encourage you to get your live questions in. Like Sydney said, we're going to try to save some time at the end of this presentation to address those as well. So that being said, let's get on to our first poll question. We're just actually trying to get the temperature of the room, and it only works if you're honest. So make sure to be honest. How often are you counting inventory? And that poll question should be coming up on your screen right now. I'll probably give you about 25, 30 seconds to get your answers in. And like I said, we'll share these at the end.
Thinking this might be
we'll
all
see.
over the place.
Sounds good.
Hopefully by the end of this, they're going to be wanting to count some inventory.
There you go. All right. And I'm going to go ahead and close the polling and share the results. This is really encouraging, Sydney. I love this. Look at this. A lot of people are already counting inventory. And a lot of people are counting it every week. There are some who are counting it every month. So we'll talk about that. We'll talk about the benefits today. The good news is the first hurdle is just counting inventory. So it looks like everybody's counting inventory. By the end of this, I want you to be validated with that decision. I want you to understand that that's a good decision that you've made in terms of counting inventory. Okay, so let's talk about cost of goods or cost of sales, as Sydney mentioned. So first things first, cost of goods stands for, or COGs stands for cost of goods. For those of you who call it cost of sales, that works as well. But how is that calculated? And when you see cost on your P&L, it always uses the same calculation. Let me kind of walk you through this calculation. So starting with opening inventory, the inventory at the start of the period you're looking at your financial information. If it's weekly, it's the beginning of the week. If it's monthly or period, it's the beginning of the month or the period. It's represented by a dollar amount of the product that you start the week with. Then you have purchases, which are probably the most straightforward. Those are the purchases that you make throughout the week. And you have to figure out and subtract any credits as well. So we're subtracting credits there. And the ending inventory is the dollar amount of inventory you have on your shelves at the end of the accounting period or at the end of the week for those of you who are counting by the week. This formula is the most accurate way to calculate the product that you've gone through during the week, and that gives you your cost. And to evaluate that cost as a percentage of your sales, which is a really smart way to do it, you would just divide that dollar amount into your sales to get your cost percentage. It starts to tell you how much money you're actually making on the food that you're selling, or the beer, wine, or liquor, or cost of goods that you're selling. Now, nobody on this call, but there are restaurants that I've worked with who actually don't count inventory. So those who say, hold up, what's this formula if I don't count my inventory? Don't spin out, don't worry. It's actually pretty simple. I have a 4th grade son who I've been brushing up on my math skills during the homeschooling, to say the least. And we learned about the identity property, which tells you if you're adding or subtracting a 0, it's going to stay the same. So just change the opening inventory and the ending inventory to a 0, and then this works. That means your cost is just based on your purchases minus your credits divided into sales. Don't even factor in the inventory. Okay, so talking about inventory, talking about that formula, Sid, how does it actually show up on your financial statements?
Yeah, so remember that your total inventory dollars actually lives on your balance sheet. This is recorded as an asset and represents the total dollar amount of product that you have on your shelves. So best practice is to try and keep this number as low as you can without running out of product, obviously. So remember, the more inventory you have on hand, the less cash you have in your bank. So with cash flow being so tight, especially with the, where we're at right now this year, reducing your total inventory will help free up some of that cash. It's also important to be reviewing your total inventory on hand, period over period, week over week, and make sure you don't have any large swings that could negatively impact your cash flow. Counting inventory is the best way to get an accurate representation of what your true usage really is. And that is, what that percentage is that Brian's talking about. That is your usage dollars. So inventory should be a total of all the food products, non-alcoholic beverage, beer, wine, liquor, etc. And for our QSR clients, then we are going to suggest including your packaging in this as well. But we're going to talk about that a little bit more later. And honestly, some food for thought, and another benefit for counting inventory is something that I did when I was running restaurants. Since I'm touching everything inside the restaurant, all the equipment, the storage areas, walk-ins, freezers, etc. By doing inventory, what you really should be doing at the same time alongside counting is actually doing a facility maintenance check. This is a perfect time, since you are touching every single one of those areas, for making sure that you're addressing any maintenance issues or catching possible serious maintenance issues in the future. So there's a lot of benefits to counting inventory, and it's not just about cost of goods, but it's also really maintaining the facility and making sure you're being proactively with that as well. So that's just my little tip of what I used to do when I counted inventory. So now that we've actually know where inventory is represented on your financial statements, what consists of that entire inventory, and I guess the question is, why does this really matter? So Brian, let's dive into that a little bit more.
Let's do it, and I want to go through it as an example. So let's take my example restaurant, and we're going to have my dream restaurant, Sid. This is Brian's Liquor Barn. We do $10,000 a week in sales. Apparently my dreams are not that gaudy. It's a pretty conservative sales number there. But let's just say, for the sake of this example, that Brian's Liquor Barn does $10,000 a week in sales, and it's only liquor sales, and you'll see why the math kind of works a little better for this example. And let's talk about what my purchases would be through a 4-week period. And let's go week by week. So in this example, I'm going to start off the period with week 1. We're going to purchase heavy in liquor in preparation of a busy month or a busy period. So we're going to have purchases of $4,000 in week 1. And this is going to get a little mathy, but don't worry. I'll show it to you in a smart way on this next slide. In week 2, let's say that, hey, we had that big first week of purchases. We purchased $4,000. We actually didn't need to place another order at all. We are still covered. So our purchases were $0 week 2. Week 3, okay, now I'm starting to run out of that key product. Need to make a little bit of an order. So we purchase about $2,000 of liquor in week 3. Week 4, one more small order to get through the month, about $1.2 thousand, so $1,200 to get me through the rest of the month. I want to illustrate the difference between a restaurant that counts inventory and a restaurant that doesn't count inventory with this specific example. So what's the difference between the two? And like I said, we're going to lay this out in a kind of mathy way. So everything I just described there, week 1, week 2, week 3, week 4, all my purchases are right here. And if I'm dividing those purchases into my $10,000 weeks in sales, that means week 1, my liquor cost was 40%. Beginning inventory plus purchase minus credits minus ending inventory gives you the 40%. Week 2, $0 divided by $0 in purchases divided by my $10,000 week gives me a $0 cost. 2,000 gives me a 20% cost. 1,200 gives me a 12% cost. Let me illustrate that on a graph as well. And you notice from week 1 to week 2 to week 3 to week 4, it kind of goes up and down and up and down. Sydney, what do we call that?
I always call it an EKG chart. Whenever I see costs go up and down, it's an EKG chart.
And I'm going to show you in a second here, it really doesn't do you much good. Yeah, my cost throughout the whole period was around an 18 or a 20%. We'll see here in a second because we're going to show you what it looks like if you count inventory. But man, if it goes up and down like that, that's not meaningful information. Let me show you what it should look like. If you're counting inventory, first things first, I want you to notice all those purchases stay the same. So in this purchase column, it's still $4,000, $0, $2,000, $1,200. But what changes now is we're actually counting that inventory that was already on our shelf. And what I want you to notice is from week 1, that opening inventory count was $1,000. OI stands for opening inventory. Week 4, my ending inventory after 4 weeks is still at $1,000. We actually went through all the product that we purchased. You'll see here in a second. And you can tell that because the inventory stayed exactly the same from weeks 1 to week 4. But watch this. If you're doing that cost of goods formula, beginning and opening inventory plus purchase minus ending inventory, so 1,000 plus 4,000 minus 3,200 gives me my cost of 1,800 divided by $10,000 in sales gives me a cost of 18%. Notice the math here works every single week. And to illustrate a point, you see here, now I have what we call a baseline cost. So from week 1 to week 4, my cost was 18%. It was a nice straight line. Now, obviously, I took some liberties here. Nobody's ever going to have a perfectly flat line. But if you're counting inventory, you don't have the fluctuations based on heavier purchases and lighter purchases. And if there's something that I want my team to dive into, maybe there's a waste problem. We'll talk about that in a little bit here in a second. But maybe there's some, this is a liquor restaurant. Maybe there's some liquor going out the back door without me knowing. I'm sure going to notice if I'm counting inventory and I see a spike, an unexpected spike 1 week, I'm going to notice the week that it happens if I have a problem, whether it's theft or whether it's waste. Man, if that same thing happens over here, I can't tell. It's going up or down anyway. It's the EKG chart like Sydney said. How do I know if there's a big fluctuation or a big waste problem? What I want you to take away from this is this up and down EKG chart when it's only based on purchases is not meaningful data to you. It's not data that's going to help give you the tools to do what all those restaurant operators are really good at and really like doing. And that's troubleshooting ways to mitigate their waste and troubleshooting, hey, customer behavior changed a little bit, or hey, maybe we have this item priced wrong, all those troubleshooting things that you like to do. You can actually make some meaningful business decisions when you're counting inventory and when you have an expected baseline there. All right, Sid. So now that we understand the difference through my dream restaurant example of counting in inventory and not counting in inventory, let's talk about some common misconceptions regarding those costs of goods.
Yeah, thanks, Brian. And there are a few. One of the biggest misconceptions is managers think that their purchases is the same as their usage, which, as Brian just showed us, that is not the case. We've got to go back to that cost of good formula. So purchases does not equal usage. Just because you've had all these purchases for the week didn't mean that you actually went through that product, didn't mean that you sold that. So whether or not that product was actually sold, it's still actually being reflected as your cost for that week, though, if you're not counting inventory. Now, the next one I hear all the time. I count inventory, and my count was high. My cost was high this period because I purchased extra. I took in this huge bulk order of vodka, 10 cases, and that's why my cost is so high this period. That is not the case at all. I hear this all the time. And the answer is the same as the first misconception. It falls into the same answer. It makes no difference how much you purchase of a particular product. If you're taking inventory, then those higher purchases, don't have any bearing on your cost of goods because you're actually inventorying that product. So the usage will still be what you actually use throughout that accounting period. Now, the next one, buying in bulk saves money. Now, this actually can depend. At times, you might be purchasing in bulk to get a large case discount. Brian's Liquor Bar, probably wanted to get a big case discount on his well liquor, so he bought in bulk, and it gave him a pretty massive discount. In certain cases, that definitely is a positive. However, there are other times when I see clients actually purchase, a case of something to get maybe a smaller discount, a dollar bottle discount, but they purchase this product that really isn't going to move. I remember when I was running restaurants, I had triples, all the bowls, liqueurs, everything sitting on my shelf. And, I order a case of that and it gathers dust for the next year. So just because, it might save you $1 a bottle to buy a case of something doesn't mean that you're actually going to use that product. So all you're actually doing is tying up cash on your shelf when you do buy in bulk. So be smart when you buy in bulk, and maybe, saving $1 here and there isn't going to actually help you out in the long run. And then the last one I hear a lot is I don't do inventory because it's a time suck. I put so much labor, it takes so long to do inventory. Why? I just don't have the time to really do this. And, quite honestly, you need to think of inventory as an investment, which in reality, it really is. You have tens of thousands of products sitting on your shelf. That is an asset. That is an investment to the business. And it should be properly received, managed, stored, tracked, etc. So why wouldn't you want to be managing this and tracking it? How else are you going to catch waste, errors, theft, etc.? It actually is going to maybe even cost less to spend a few dollars on labor to do the 2-3 hours that it's going to take than the hundreds of dollars worth of product that you could be losing due to poor inventory controls or even ordering, etc. So it's really important that you actually think of your inventory as an investment, that you dedicate the time and resources to it, and make sure it's consistent and accurate, because the more accurate, the more consistent it is, the easier it's going to be to identify areas of opportunity and immediate areas of concern. That way you can be proactively managing your costs and understanding exactly what is going on with them.
And Sid, I want to pause right there real quick, because that's a really important point. When you're thinking of all the time and treasure you're putting into inventory. And what we're trying to say here is that the money that you're going to save by getting your management team engaged in that inventory process and having a real baseline that they can make meaningful decisions on, you're going to save more money with the impact they can have with that true information than you are investing into the actual labor dollars that's costing to do that. That's a big eye opener for a lot of restaurants who aren't counting inventory, I think.
Which actually leads right into best practices because, if it is taking a long time, then maybe we need to streamline the process with your inventory as well. There are ways to be able to get this very streamlined so that way you can go through it as quickly as possible. So it isn't costing a whole lot of extra labor dollars. So let's talk about some of best practices when it comes to counting your inventory. I always recommend, and what I always did was a 2-person counting system. So I always had the same person call out the inventory as the same person that was recording it. I like to have 2 people on it because that way you can make sure that nothing gets missed. And if there's any new product that you might have actually, purchased and maybe didn't get added to the count sheets, the person recording can quickly add that on the fly. This also gives consistency. If you have the same person calling it out, then they're always calling out this, the same way every single time. So now you've got that consistency happening, which goes right into the next item, consistent counting units. Make sure that you're counting the product the same way each and every time. Regardless of how you purchase it, make sure that you understand how you're going to count that product to make sure that everything's updated with that counting unit and that counting unit price. Now, the next one obviously is a no-brainer. You probably all are doing this, shelf to sheet. The more you make it shelf to sheet, the faster that you can fly through it. So, have dedicated count sheets for each individual area. Try and make it flow on your count sheets so that way you're literally going shelf by shelf and reporting it. That will really help increase and speed up the process. Now, another thing to help to address that time issue is keeping those inventory levels low. Not only will having inventory levels low make you go through the process of inventory counting much quicker, it's also going to help you manage mishandling, theft, spoilage, et cetera, because the lower amount of inventory you have on hand, the easier it's going to be for you to remember how much you had the last time you counted and how much you really should have gone through. It's going to help you identify areas of opportunity right away, the lower amount of inventory that you have on your shelf. And bonus is going to help with cash flow as well.
Yeah.
Now, with, I mentioned supplies earlier for our QSR clients. Quite honestly, when it comes to just normal full service restaurants, if you can't consume it, then don't count it. This should be budgeted out. And managers should be utilizing a declining spending budget to manage their supplies as well as their paper products and to-go packaging. This should be something that is being purchased along with levels of sales, so we don't over-purchase those areas. But I wouldn't necessarily count it. For QSR, obviously that's a different beast in itself, and to-go packaging and paper products would definitely be something that I would recommend. But for normal brick and mortar full service restaurants, keep supplies and paper products out of the inventory process. This actually can save you time as well. But make sure you are tracking spending levels on this. Make sure you have a budget in place and you're, ordering to those levels. So that way you don't have a lot of extra products sitting on your shelf. Just like all of your consumable product, all that paper product, that can really add up with a lot of dollars sitting on your shelf as well. So don't have a huge storage area of it because all it's going to do is gather dust and tie up cash. So try and keep your purchasing on your to-goes and supply purchases as low as possible and in a budget.
And what I hear you saying, Sid, is just because you may not count those inventory items, the supplies, the paper products, doesn't mean you ignore it. Like you said, you still budget it, you still have some accountability there, but may not be a revenue producing activity for you to count that product.
100%. So I think that's a good time actually to kind of go into some of those best practices, Brian, how to manage the waste and things like that.
Absolutely. Yeah. You aren't going to be able to leave this webinar saying we didn't give you some good best practices. So let's get on with that. Best practices for managing and controlling your waste of food and bar programs. So Sid mentioned it already, but a declining spending budget and ordering par levels kind of go together, right? And I want your order writers making their own par levels and factoring in what the sales forecast calls for. So first thing is get the whole team involved in forecasting and then make sure those order writers know those pars should be as fluid as your sales are fluid. How do you do this? You use a declining spending budget that keeps track of those purchases throughout the week and tells you how much you have left to spend. For RSI clients, that's your budget versus actual widget. So if you're unfamiliar with that, reach out to your client advisor and they can help you with that. Another
Brian,
best practice. Oh, yeah.
And also on those par levels, you mentioned them being fluid, and I just want to, actually expand upon that. Just because you have a set par on something doesn't mean that you necessarily have to be ordering to that par level. Brian said it. Your sales are fluid. Your sales, and par level might be based off of, one level of sales, but your sales that you have currently might be at another level. So remember, a par is a baseline, but you should actually be ordering based off of what the actual needs are based off of the sales that are occurring currently.
Especially right now, right? Because I'm sure there's some restaurant out there who still has the same par levels from 2019 that probably has diddly squat to do with what they actually should be ordering right now. This should be fluid. You should be changing this every week. I think it's a great point. All right. Now we talked about it. So now talking about a little bit of waste tracking. So every once in a while, I start working with a restaurant who actually tracks their waste by ringing it in and discounting the product to a discount that's called waste or spillage. I actually don't recommend doing this. You're potentially misrepresenting your sales. You could even trigger use tax expense on your monthly sales tax. I recommend, and again, Sid and I are kind of old school, but I recommend using a clipboard or even a waste bucket in the kitchen to help quantify that waste. Or if you insist on ringing it in through the point of sale, void that sale instead of comping or discounting it. Void the ring in with a category of waste so that you have that information to bring to your weekly manager meeting when you're troubleshooting why your cost seems a little bit higher than normal. And yeah, let's come up with a game plan to lessen the amount of waste, which we can quantify each week, either with that void report or with the old school clipboard that Sid and I would have, or with the amount that they recorded that was in that big waste bucket, right? Sorry, I don't mean old, Sid, I mean old school.
I got it.
All right. I do also want to mention, I have worked with some restaurants or in some jurisdictions where you actually are required to ring in your spillage, especially liquor, to ensure it's all accounted for. So make sure you check with your state to see what you need to do there, or RSI clients, shoot us a support request and we'll help guide you there.
Yeah, and if there's any questions, our compliance department will let you know exactly what is use tax applicable, et cetera, and make sure that you're set up for success with that. But check before you start ringing it in, because there is definitely implications regarding it.
Well said. And along with waste, we're going to talk about my favorite acronym. If you've been on our webinars before, you've probably heard this one. But back to my restaurant days, I used to use the acronym WEPT when troubleshooting waste. So once you validate your information's accurate, your food cost, your pour cost, if you know there's a difference between what your cost should be and what it actually is, this is where you can use your detective skills to determine what is causing your waste. Use the entire team in this process, but talk about what could be causing your waste. And WEPT is a great way to kind of go through that process in a pedantic way. So W stands for waste. Is it truly waste like spoilage? And what is causing this? Is it over ordering or those par levels from 2019 that are causing this? The E stands for error. Is it a mistake in the way the servers are ringing in something through the point of sale? Or do they not ring it in correctly or re-ring it in correctly? Do they know the difference between a void and a comp? This is a hot button at a lot of different restaurants, and there's a lot of myths around there. The P stands for portion size. So I love the saying, restaurants are a business of pennies, right? And if half an ounce of extra dressing is going on your salad, and going on every salad, half an ounce extra dressing, those pennies add up quickly. I don't have to tell everybody on this call. And lastly, the T stands for theft. Another thing that kind of comes with being in the restaurant business. Is it going out the back door? Is it being given away to customers without being rang in? You always have to consider that as a possibility as well. Also, low inventory levels. This is either the second, I think it might even be the third time we've mentioned it during this webinar. And guess what? There's a reason for that. So the lower inventory levels are proven to minimize your waste. The less product available, the less likely your staff is to overportion. And look, I'm not trying to say that you should keep your inventory levels so low that you're running out of product, because that reflects poorly on your brand. But I kind of hate over ordering just as much.
100%. Which I think plays right into our next poll question.
It leads right into another poll question. And this one should be a pretty straightforward one. And while we're talking about cost of goods, a way a lot of restaurants can save money is making sure that they're affiliated with a group purchasing program. So I'm going to throw it out there again, just to get a feel for the room. Are you currently affiliated with a group purchasing program? And again, I'll probably give about 20 seconds for everybody to get their answers in.
I wonder what the results will be on this one.
We'll see. We're getting a lot coming in.
All right.
I want to make sure everybody has a chance. So I'll give you another 5 seconds. All right, looks about 75% of people have responded. So I'm going to go ahead and end the polling and share the results. Sid, this might be an opportunity for some people to save some money, right?
Yeah.
A lot of no's.
You know, we're always trying to think of things to help reduce costs. Obviously, you are all very proficient in managing everything within the four walls. But there are also other opportunities out there for you that maybe you could be taking more advantage of, you know, and this is all about building that vendor relation with all of your direct vendors and reps from all of your food and beverage vendors. If you are not currently involved in any rebate programs or GBOs, then you might be missing some cost savings that could help decrease your overall cost of goods. A group buying organization actually leverages the purchasing power of all its members to negotiate contracts with the suppliers that end up benefiting everybody in that organization. By being part of a group, you've got that strength in numbers, which leads to lower product costs that you couldn't attain on your own. So if you only have 1, 2 locations, and obviously, you know, you don't have a huge bulk buying power like a national corporate chain, finding and being part of a GBO can help you be able to get and maximize those savings that those national corporate chains are actually getting from negotiating their own rebate programs. So find out what you've got available in your area. Check with your main distributors to see what programs they might have available to you. Even your carbonated beverage vendors, like I've negotiated rebate programs with Pepsi, Coke, etc. They all have things in place. So you might be able to get a distributor deal or a group buying organization, but you should look into this because there is savings to your costs. Now, for those of you that are an RSI client, we actually have an additional option for you as well. You know, in an effort to continue to help our clients, you know, save as much money as possible, we actually have implemented our own purchasing program exclusively for our clients. Now, this isn't a group buying organization, but it almost acts as one. We actually did all the negotiations and partnered directly with the manufacturers at the manufacturing level to pass on rebates on specific items and purchases for all of our clients. So we actually use the purchasing power of our 2,000 clients to negotiate, you know, over 56 programs consisting of over 50,000 different items and services. We've also partnered with new packaging vendors to assist on better pricing on to-go, et cetera, since obviously that's where we're headed with this off-premise sales. We've also partnered with Cintas to help give a reduction on costs on linen, et cetera, and negotiate set pricing. This is all very important, and this is all that's going to help to what, you know, Brian said, pinching those pennies, saving every single penny. So regardless if you're with RSI and using our purchasing program or you're going to look for GBOs in your area, I strongly recommend that you do this because the more that you are getting discounts and rebates and, you know, locked in pricing, the better that you're going to be able to meet that lower cost. And right now, we say it 3 times already, every penny counts.
Yep.
So I think that actually leads into our final poll question, Brian.
And this is really just so that we can make sure that any of our clients have the opportunity, if they have any questions about the purchasing program we have, if they want to chat with someone on the purchasing team, we can have them reach out to you. So we just want to make sure everyone has that opportunity. So there's a poll question up on your screen now. Would you like someone from RSI's purchasing team to reach out and discuss our program and potential savings? This is probably more for those. We had a mix of RSI clients and non-RSI clients on the call today. So this is probably more geared towards RSI clients, but it wouldn't hurt to have the conversation with a member of the RSI purchasing team, even if you're not a client. You can learn a little bit more about the program. Okay, we have about half of the attendees have answered. I'm going to give another 10 seconds to get your answers in.
Yeah, and I think I may have forgotten, our purchasing rebate program for our clients is actually zero cost to our clients, and there's actually nothing you have to do. we simply download all the information and import it from all of your purchases, and we let you know every quarter how much you got in savings. So it's
like a AAA membership, right? Where you just get perks at different places.
Yep.
All right. I'm going to go ahead and end that poll question. If you did answer yes, we will have somebody reach out to you. So thank you for those answers. And Sid, we're right at 35 minutes. So we did a great job of staying within 35 minutes. We didn't do a great job of leaving a ton of time for questions, but I saw some come in that I want to make sure we get to. So let's try to get to at least one or two. If we didn't get to your question, and there are going to be some I can see out there that we aren't going to be able to get to, just know we will reach out to you directly with an answer to your question. Thank you to everybody who got those questions in. Okay. And I like to kind of theme these up. So the first one, this is a perfect example of a few different questions we got, Sid. And it's about sales bases or sales bases. What sales should I be dividing my costs into? Do I just divide it all into total sales, or is it better to be more specific? So thank you for that question, Sid. That's a good one we like to talk about, right?
It's a good one, and I can't believe we didn't mention it. So when you are looking at that cost of goods formula, the sales basis should be the sales for that cost basis. So for instance, food sales will be a cost percentage of, or food costs will be a cost percentage of food sales. Liquor cost, liquor sales, any beverage cost, any beverage sales. So whatever your master sales departments are, you should have corresponding cost categories, and this percentage should be based off of that specific sales basis. Great question.
Great question. I also see one that is true to my heart, so I'm going to get this question out there. This is a classic one. I use limes in the bar and in the kitchen. Where should they be categorized? I get this all the time, and I'm going to start off with the way you can do it that I actually don't recommend. I'll tell you why. So first of all, if you use limes in both the bar and the kitchen, if you want to account for that perfectly, you could have a line that's set up to go to your pour costs and a line that's set up to go to your food costs. And every time you purchase limes, you could separate that out in terms of accounting. I think this would be a ridiculous step to take. If it were my restaurant, that is not a revenue generating activity. What I actually commonly suggest is that you just decide where does it have a bigger dollar impact and pick there. For a restaurant that sells a ton of margaritas that garnish with limes, chances are it's a bigger dollar amount in your pour cost, and you're just going to have limes be a bar consumable or part of your pour cost. If you don't have a lot of margaritas and you have, a lot of limes that get used in dressings or something for salads, then maybe food cost is where I want you to categorize it. I kind of just want you to pick one and tell your head bartender and head chef to stop fighting over which category it should go into, food costs or pour cost. I laugh because this has happened to every restaurant I've been in. That's a perfect question.
I'll add to that too. I always turned out to be kind of a wash. Yeah, I might be taking lemon and limes from the kitchen, but then they might be taking whiskey and beer from me for, their sauces or, prep items too. there was always kind of a, you take a little bit, I take a little bit, it kind of washes itself out. If there is a large expense because the bar is going through a ton of limes because it's margaritas, well, obviously then that makes sense and there wouldn't be as much of a wash. But kind of figure out what the kitchen uses from the bar side and what the bar uses from the kitchen side. Kind of, you'll find that typically 9 times out of 10, it's going to be a wash on the expense. Good questions.
Great question again. Yep, I think that brings us to the end. So up on the screen right now is some contact information. If you have any questions that you didn't get a chance to ask today, please don't hesitate to reach out. Our email address is up there, theclientadvisors@rsiaccounting.com. We have a phone number up there. We'd love to hear from you. But mostly, thank you to everyone for joining and participating today. This was a fun one for us. Hopefully you guys enjoyed it too. Thanks,
Thank you so much. Thanks, Brian. You guys have a great day.